you saw part 3 of my series on financial literacy, we covered all the different kinds of taxes that every earner must pay. However, I mentioned that there were ways the government provides to save on taxes, so today we'll go into depth about how retirement accounts and real estate can help you do this. Hi, this is newFire with a video on how you can save on your taxes. So the very first retirement account type I mentioned in my last video when introducing tax-saving plans is the 401k. It's a popular workplace retirement plan where you can contribute up to $20,500 per year. In addition to that, similar to Social Security, most employers provide some percentage or full amount of that $20.5K. For example, an employer might contribute another $5,000, bringing the total deposit into your 401k as $25,500. This is great and all, but the question is, how exactly does this help save your taxes? Well, imagine a scenario where you earn $100,000 per year, and you contribute $20,500 of that to your 401k. After opting for that, you have $79,500 left. Now your taxable income is actually only $79,500, not the total $100K you earned that year. Now that your taxable income has decreased, you pay a smaller percentage of tax than you would had you not contributed to your 401k. Traditional IRA is another retirement account, but you are only able to contribute up to $6,000 per year. Both the 401k and traditional IRA are pre-tax savings, meaning you can access these accounts only after you retire, and once you use the money from these accounts, you'll be taxed on it since that's now your income. Though you'll get taxed after you open these accounts, this is better than paying the income tax from when you were still earning, because now your taxable income will most likely be smaller. Roth IRA is also a retirement account, where again you're only able to contribute up to $6,000 per year. But what makes it different is that unlike the 401k or traditional IRA, a Roth IRA is post-tax savings. So say for example you contribute $6,000 to a Roth IRA, and in 60 years, say it grows to $100,000. When you show the government that you're contributing $6,000 of, say, your annual income of $100,000, you'll pay the federal income tax of the full $100K, but you don't need to pay any taxes on the amount in your Roth IRA after that. So after you retire and open the account to use, the money in there is exempt from federal income tax. So many people don't like contributing to these retirement accounts because you can only open them after you retire or at 62.5 years old, and not any time that you actually need it before then. That's why there are other savings plans you can use, but they only apply for specific purposes. One popular savings plan is the 529 plan. There's no annual amount on how much you can contribute, only that in a 5-year period you can contribute up to $80,000. This plan allows you to never pay federal tax on whichever amount you contribute, and you can also withdraw this at any time. However, the 529 plan is a savings plan for education. The only use of this money can go towards higher level schooling or any other fees incurred from receiving an education. Lastly, the HSA stands for Health Savings Account, towards which you can contribute up to $3,650 per year. Like the 529 plan, you'll never have to pay a tax on the money in this plan and can withdraw it at any time, but it can only be used for medical expenses and nothing else. So if you contribute some amount of money at the end of October and you have a medical bill to pay in the middle of November, you can use the money you contributed back in October for that. To reiterate, both the 529 plan and the HSA can only be used for educational purposes or medical purposes, respectively. And one important part to know about all of this is that the contribution limits I mentioned earlier for each plan constantly change year by year, so you should keep that in mind and be sure to check the limit for each year that you contribute. So now that we know that even though the government requires us to pay so much on taxes, it also does provide some ways for people to be able to lower the amount they pay and even use that money for the future. However, it's important to be careful with how much you contribute and make sure that you won't need that money you contribute now or in the near future, since many of these plans only allow you to access that money much later. Thanks for watching and stay tuned for my next video. This is newFire signing out.